Hi everyone, so with the devastating war Russia is waging in Ukraine and the effects we're feeling and seeing in the stock market, coupled with the Fed's fight against inflation, there's a lot right now to be concerned about. Today's investor question is, when will the pain end? And what should we do with regards to our investment portfolios? Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. Well, first of all, our hearts and prayers are with the Ukrainian people. With the proliferation of smartphones and access to the internet globally, this is the first war that we're getting real-time updates, vivid images and videos of the devastating effects of war faster than ever before. No one really wins in war. The world loses, and we hope and pray that there will be a resolution and peace established quickly. One observation to note is the power of global networks and the devastating effects sanctions and a coordinated effort to stifle Russia's economy can have. Russia will feel the effects of these actions for a very long time. But we're a financial channel, so let's get to the question at hand. When will the pain end? Well, simply stated, we don't know. Yes, history rhymes, but it rarely repeats itself, and there's plenty to cite that supports saying this time it's different. What's not different is that it's all about time in the market and not timing the market. It's well documented, as you can see here, the penalty investors can incur trying to time the avoidance of losses and buy low and sell high to participate in only the upside. It's flawed thinking. So how long will we suffer this downward trend in markets? Mark Armbruster conducted an interesting study comparing market performance during times of war. Interestingly, as can be seen in this chart, the returns of large cap and small cap stocks across all the war times versus the time frame of 1926 to 2013 were higher and had less risk to boot. The Gulf War lasted less than a year, but it was also the first time we experienced a brief recession during a war, something that gave evidence to the fact that the US economy had changed to a more knowledge-based service economy, as opposed to being a heavy industry manufacturing economy where the increased military demand had less of an impact. This has only become even more so globally with developed nations. On this next chart, we can see the impact of geopolitical events on the S&P 500 index. This chart shows the total drawdown, the percentage decrease from top to the bottom, and how long it took the S&P 500 to get back to pre-geopolitical event stock market levels. Interestingly, if you average the total drawdowns of the S&P 500, you come out at about minus 5%. On average, it took 22 calendar days to reach the bottom and 47 days to make a full recovery. Note the Iraq invasion of Kuwait caused a drawdown of minus 17% and took 71 days to bottom and 189 days to recover. Again, we don't know how long it will take for this current conflict with Russia and Ukraine to end, but it's interesting to look back at history and see the effects it had on financial markets. So what should we do? We continue to believe that selling and going to cash or investing in bonds is not the way forward, even during times like these. We believe the best way to achieve excess returns without excessive risk over the long term is to, 1, identify great businesses with enduring pricing power and long-term volume growth opportunities. 2, minimize other long-term business risk factors by partnering with ownership-minded management teams and avoiding companies with aggressive capital structures. 3, avoid overpaying by focusing on high-quality business mispricing, by remaining vigilant to market timing mispricings, and by comparing the forward risk-adjusted rates of returns of our businesses with our investment alternatives. 4, diversify as much as possible among the attractively priced great businesses we've identified. And finally, 5th, wait. This approach has served us well over the years, and we believe it will continue to do so in the future. That 5th point can be the hardest, especially when we've experienced such robust returns over the last 3 years. Keeping the long-term view in mind is critical. When you look at the long-term results of stocks versus bonds and treasury bills across all these different countries, you can see the real annualized returns of equities has significantly outperformed bonds and T-bills despite the incredible and devastating crises during that time. In a letter to our clients that we penned at the end of 2020, we talked about being adaptable. We believe these words remain true today. Just as our companies have to respond to future surprises, we as stewards of your capital have to be similarly willing and able to adapt. As conditions change, innovation occurs, and the world evolves, Some important industries of today will wither and die. Some cultures of iconic companies will become stultified or too short-term focused, and their businesses will slowly erode. In their place, new industries and aggressive young startups will emerge. Our job is to evaluate all these new developments and to adjust the portfolio mix accordingly, selling the businesses that can't or won't evolve, and buying the ones in new industries that we believe can produce high and sustainable returns. Usually as a result of owning a dominant network in an industry that we think can grow at least as fast as GDP over time. As we reflect back over our time managing portfolios, while we've made mistakes, we believe we've successfully navigated many of the large changes in the economy, such as the decline in the fossil fuel and traditional media industries and the rise of the internet economy. And we're cautiously optimistic that our strategy of blocking out short-term noise and focusing firmly on the long term will continue to bear fruit in the years ahead. Change is inevitable, and being adaptable while remaining disciplined with a strategy that is laser-focused on investing in companies that have enduring pricing power and long-term volume growth opportunities is the key, in our opinion. Remember, we eat our own cooking, and we're invested right alongside our clients. As we've discussed in the past, we're constantly looking at forward rates of return of all the stocks that meet the criteria of our investment framework. Our goal is to seek to build portfolios that have the highest risk-adjusted forward rates of return. This helps us take the emotion out of investing and to analyze securities in a methodical, analytical way. Ray Dalio recently wrote these sentiments on power, quote, "It's important to use power wisely. Using power wisely doesn't necessarily mean forcing others to give you what you want, i.e. bullying them. It includes the recognition that generosity and compromise are powerful forces for producing win-win relationships, which are fabulously more rewarding than lose-lose relationships. In other words, it is often the case that using one's hard powers is not the best path and that using one's soft powers is preferable." Close quote. We hope and pray that our world and corporate leaders will use their power and spheres of influence wisely, that our connectedness will create more win-win relationships, which surely will support and bring to fruition this continued rising wealth and growing middle-class expectation that we believe will continue to benefit the businesses that we're currently invested in. Note that the growth of these GDP per capita lines are not smooth. We'll continue to have global gyrations when it comes to business cycles moving up and down, but it's important not to overlook the long-term upward trend of rising global wealth, and also not to overlook the incredible future growth that a growing global middle class that, in our opinion, will greatly benefit the businesses that you're currently invested in. Thank you for your continued trust and for the great question today. Check out our other videos, and we'll see you next time. All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos, and we'll see you next time.